We're about to hit some turbulence, ladies and gentlemen, so buckle up because it's going to be a wild ride. That's what we're going to talk about here on today's Stock Market Brief Show, getting right into it on today's episode. So if you aren't paying attention, pay attention now because it's going to get right into the data. Look at what I'm showing you here on the screen. This is the S&P 500. And let me just show you something. Volatility, implied volatility. There's two types of volatility. You have implied volatility, IV, and you have HV. HV is historic volatility, what has already happened. But I want to point out implied volatility. Implied volatility has been increasing. You can see that in the weekly expected moves. You have a $7.7 weekly expected move to a $9 expected move to a $10 expected move on the SPY. And you'll notice something here. Not only do we close within the expected move 68% of the time, and the S&P 500 is technically higher, but we typically tag the expected moves, and we haven't done so yet. And this is one of the biggest weeks. We've gone two without, and now we have a bigger week of implied volatility. Now, the reason why I talk about this, and I posted it on Twitter, I said, let me break it down for you, because I got a lot of attention here on this whole next week, the S&P 500 is going to move 107 points. The reason why I said that, there's statistical evidence to believe it. Okay, it doesn't mean it's going to for sure happen, but let me break it down for you once again. This year, there has been 40 trading weeks. We're on 41 right now. Only 8 of those 40 trading weeks, we did not tag the expected move. So that gives us an 80% probability this year that we tag the expected move at some point. Now, 2 of those 8 happen to be these last 2 weeks. Now, it is incredibly rare to go multiple weeks without tagging the EM, the expected move. If this doesn't happen, we can see an explosive move. Why? Because open interest builds inside of a very tight range. Now, last year, there was 52 trading weeks, 13 of those weeks, because I know people are going to go, well, what's the historical data? 13 of the 52 weeks did not tag the expected move. That's a 75% probability of tagging. I like the odds of tagging an expected move, whether that's to the upside or downside. We'll talk about that momentarily. Now, in 2023, there was one occurrence that we went 3 weeks in a row without tagging it. So it is possible. It's possible to go multiple weeks. But very shortly thereafter, that was from April 3rd to April 24th. After that, we saw explosive volatility. It shot back in both directions. And then we went on a 10% run in the S&P 500 before it all came back down 10% lower. That was the correction in 2023. So we don't have to tag this expected move. We don't have to. But the probability, if we're thinking in terms of probability, there's a high likelihood of us tagging this expected move this week. And if we don't, there's even a higher probability that it comes in the remaining week. Now, the reason why I say buckle up is because this is a larger implied move. It's $10 in the SPY. Today, we were down slightly. Well, let's take a look at the market. Energy led the way. That's actually not a good sign. We've discussed that on a prior episode where energy, when it outperforms the S&P 500, you typically see weakness in the S&P 500. And well, we're seeing the S&P 500 fall in relative. Let me just reword that. We've seen energy rise stronger here. This is an energy chart. This is energy relative to the S&P 500, and the S&P 500 is hardly even backing off. Okay, so that's what happens when energy outperforms. And when we see that, you can typically say, well, oil typically has a strong correlation to energy, and it does. And oil's been on a monster run-up, so this could be in due part because of geopolitical fears, absolutely. But what happens here, too, with the rise in oil, you can typically see the 10-year yield follow there shortly after. So not only did the Fed cut rates, and now rates are exploding higher, this could have to do with the move in oil and what's going on with potential inventories, potential fears overseas or for geopolitical fears. Could be a number of things. Could be a number of narratives, and we could find out the main catalyst, obviously, later. Now, not only that, we're seeing the CRB index rise. So this is interesting to me because, you know, within just early September to where we are now, the CRB index, which is a good gauge on inflation, is up 10%. So is the market saying, hey, and the CRB index, right, a huge portion of that is energy. But is the market starting to say, oh, yeah, we're starting to cut rates. Maybe this was a little bit too soon. We're taking a victory lap, and inflation could potentially pick back up. Hey, we got to keep that in our back pocket. Look at the yield curve. The yield curve is starting to go back into an inverted state. It's not there yet. But what I do want to call out is we have the 10-year 3-month trying to fight through an inversion. Now, I put a video together about the 10-year 3-month when it inverts the 10, the 20, and the 30. And the only times that has done it, in the last 20 plus years, 25 years, was in 2007, right? '07. And then also in 2000, right? Those were the most recent last two times. And when they started to begin uninverted is where we start to see some more volatility and more problems. So we'll see. It's still not uninverted yet, but it is steepening. So we got to keep that in our back pocket there too as well. Now, if we take a look at the current target rate for the federal funds rate, it's at 475,500. The market is now 86% probability in November that we're going to get a 25 basis point cut. Just so you remember, just not too long ago, it was 50 basis point cut. That's what we were pricing, another 50 basis point. But now, if you look over here, now we're starting to get a probability, a 13% probability, that we're not going to get a rate cut at all. If you go out to December, you can take a look here, saying there's about an 80% probability that we'll be around 425 to 450, which, once again, it's not that big of a move down from where we currently are, which is 475. Okay, so 475 down to 425. What is that? It's 50 basis points, but there's also a probability increasing less than that. Okay, let's continue on and look at the probability so you can visualize the change. Well, we were pricing in more rate cuts, and you can see that over here, we're looking at to the end of the year in December being at around 4%. But now you can see the probabilities of that have been dropping to its current level, while the probabilities over here have increased, and even out here have increased. Okay, so the market's kind of repricing in things as we're getting this move in oil, potential inflation fears. Could be a number of different narratives, but that's what the market's doing right now. I did find this chart to be interesting a while ago. I posted this back in March, and the Bollinger Bands, they got so tight. And remember, markets move between contraction and expansion. And what I find interesting is the follow-up on this chart. But we posted this March 15th. I posted this March 15th. Bollinger Bands, they were getting very, very tight on the weekly time frame, so much so that we haven't seen it this tight since 2007. And we said basically, as this straight and sharp bands are contracting, they eventually expand. Well, what happened? Well, you can see we saw in 2007 an expansion in volatility, came back in, and then it chopped up higher, and the band started to expand again. What I find interesting here is this was also around the same time frame as far as the part of the year. All right, and then it went into the 2008, and then it obviously saw the big spike. Not to say that that's going to be the same thing that happens, but you can see we had the initial spike higher. The bands expanded, and then we came back down, right? We spike higher, came back down, chopped one, chopped two, chopped three, and now we're going boom, one, boom, two, boom, three here. So it's like almost like it's rhyming. It's pretty crazy how that's taking place. But, can you trade based off of that? No, I just thought it was cool. What you can see is the term structure is in backwardation. What does this mean when the term structure is in backwardation? Let's just forget the word contango. Let's forget the word backwardation. Let's just say here, hey, the market says there's more fear here now than it is looking into November and December, which is interesting because we have the election and stuff, obviously not right in this current moment. We have the, obviously, voting and stuff. But what does it see? What does the market see to say, hey, there's more fear now than we see, November, December? Now, this could change, but that is where it's currently at now. Typically, what you'd want to see is this, right? This is the market saying, hey, yeah, we see more fear into the future. Right? Yeah, that's typical. You look at back month versus front month volatility, it's kind of getting slammed down here, which typically can help us find bottoms, which we've seen bottoms like that before. But like I said, we're in backwardation, so it's a very interesting time. And while this is happening, we see the dollar flying up. So why is the dollar moving up like this too? And the S&P 500 has hardly been touched. Now, there's typically a negative correlation with this, where the dollar fires up, the market can come in. So is there a delayed reaction in the market, or is the market strong as heck right now? And if this starts coming off and backing down, the market's going to go for its run. And we got to be open for that possibility. Got to be open for both possibilities. But if you can see this chart clearly, what you'll notice is when we topped out here in the dollar and started falling, what did the S&P 500 do? Started rallying up. Okay. Let's continue on here and look at gold. I found this to be interesting too. Gold is more of a safety type trade, and gold is holding up very well on the move with the dollar. So if the dollar does decide to back off, is that going to initiate the next move in gold to potentially hit another new all-time high? Now, there's a lot of concern in the month of October. We know that it's a spooky month given it's Halloween. But two, typically you have more volatility in the month of October, including the election years. You can see here in blue where you get this spike down and then it shoots up and everyone gets excited. They get faded. And then into the back half of the year, you get the rallies, and that's what we got to prepare for. So how do we prepare for it? There's a couple things that I look at. One of the things is gamma. And I'm looking at this right now and I'm like, wow, there's like nothing below us And there's our traders reaching out higher, but we need to claim some of these levels to feel a little bit more confident, right? So 57.50, we got to get above 57.50 because there ain't nothing to bring us, to save us from falling to a bigger area of concentration from the put perspective. So when I pull up this gamma chart and we look at the gamma flip line tells us how dealers can hedge or how dealers are going to position. So when we're below a flip line, to make it easy, that's when typically volatility increases, okay? They sell into selling, they buy into buying, you get much more volatile swings, both to the upside and to the downside. We're basically in the zone of the gamma flip line. So you can, to some people's software or reports are going to say they're negative gamma. Some are going to say, we're technically still positive. Whatever, okay? We're basically at the gamma flip line, which is a little bit of a dangerous zone. We need to see what the market does. But 57.50 is up here. And this has been just a level of concentration a lot of people have been focused on. And beyond that, 5,800 would be a level that we really do need to get above. Below the flip line, 5,600. It's like there's nothing down here until 5,600. So if we get some sort of boom, explosive move to the downside, be paying very close attention to that 5,600 level. I want to point out that technically we are in negative gamma territory according to this source, which is Gamma Labs. I like to use Gamma Labs. And you can see there's multiple times that we fell into negative gamma territory. You might be saying, well, what happened to the market during those times? I mean, we're at all-time highs, right? Well, this is what happened when we were in negative gamma territory according to the VIX. Once we got into negative gamma territory is when the gray box starts. When we get out of it, that's when it ends. And you can see when we got into it, the VIX rose, 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 and well, the VIX is rising right now too as well. We don't know how high or how far it's going to go, but it does tell us that volatility typically increases. And when volatility typically increases, what does that mean? Well, it means this. If you have a $100 portfolio that you're trading and you're used to it moving, up and down $1,000 a day, but yet all of a sudden volatility doubles, you're going to be looking at that portfolio swing $2,000 a day. All right. That's what happens when volatility increases. You get bigger swings in both directions. So you can adjust for that when you start to approach the markets. Typically, one thing that I personally like to do is if I take a position, one, it's going to be a good setup, but two, it's going to be a smaller position and allow for a wider stop, given the context that I know that we'll probably see the market do some more fake outs and shakeouts. So we're in negative gamma territory, and where are we according to the 5-day moving average? We're below a declining 5-day moving average on the SPY, on the Qs, on the IWM. Semiconductors is holding up rather well, above an inclining. XBI, biotech, below a declining 5-day moving average still, and DIA, a lot of chop, but it is below a declining 5-day moving average. So in very short, in these conditions, when we're in negative gamma, when we're below a declining 5-day moving average, I'm not looking to add exposure unless if it is an A+ setup. What I do is I manage the positions that I currently have on. If I get stopped out of positions, I don't worry about it. I look to add when the market proves itself and starts showing strength again, and we go back into positive gamma, and then the market all of a sudden starts going like this. Buy the dip, sell the rip, volatility decreases, and I can play my cards on the positive side of the trend. I know some people like to short, be my guest. I'm not looking to do anything too crazy right now. And that is what I do to keep my portfolio from, if we do all of a sudden see a big spike in volatility and the market comes in, my portfolio is going to level out to go slightly down on the current positions that I have, maybe get stopped out. But then when things start to turn up, then I want to catch the next leg, the next wave, obviously higher. Okay, that's my thought process there. Let's take a look at what's on deck for this week. We do have core inflation data coming out today. We have the FOMC minutes. We'll see if anything changes there. My guess would be not too much, but we'll see. So Thursday, we have core inflation data. Friday, we have PPI. This is obviously what's bringing the volatility, potentially helping us get into that backwardation because they see potential fear here that, hey, maybe inflation is going to be, we're going to go above consensus. And that's going to oh no, what is the Fed going to do now? And that could be why we're seeing these subtle changes here in the market. If we take a look at the 15-minute time frame, tomorrow's daily expected move, it's about $4+, 571 to the upside, 463 to the downside. I'd be looking at the lower weekly expected move at 562 and or the upper at 583. As it stands right now, we're below the quarter-to-date anchored volume weighted average price. So I would prefer, if I'm going to get bullish, I'd want to be back above the 5-day moving average. I'd like to see it inclining, and I'd like to see back into positive gamma territory. Until then, I might look at overshots to the downside to look to fade, maybe intraday. But I'm sitting on my hands. I'm letting the market do its thing. And when it shows strength again, I'll get back in. It's going to be as simple as that. I'm going to try to keep it to the point here tonight. Hope that helps out. See you later.